Okay, greetings. Welcome to Stifel's webinar. I guess we're thinking of it as an environment with amplified uncertainty turning to increased volatility. And so we wanted to spend some time today and discuss drivers of the situation, drivers of volatility, and also, look at it through the lens of things like the economy, what's going on in DC, and ultimately bring it back to markets and where we see things going from here. I'm very, very pleased, as always, to be joined today by two very capable colleagues. Dr. Lindsey Piegza is Stifel's chief economist. Lindsey, welcome.
Thank you for having me.
And also Brian Gardner. Brian is Stifel's chief Washington policy strategist in DC as we speak. Brian, welcome.
Michael, thanks for having me. It's great to be on with you and Lindsey.
Excellent. Well, really glad to have both of you. So what I want to do is basically we're going to break our session into three parts. I want to just set the stage a little bit in terms of the environment that we're facing in 2022. Then really we'll turn to kind of a roundtable discussion among the three of us to sort of tease out, again, some of the drivers and effects and things we're seeing. And then we'll close out with a look forward, really, in terms of the economy and ultimately the markets and where we see things going from here. So with that, let me go ahead and throw some slides up to get us started. And essentially, increased volatility. When we started the year, we felt so bold when we were issuing our outlook to say volatility was going to go up compared to 2021. It was pretty benign last year, and I think we all got pretty complacent with it, but it really has jumped up this year, and there are a few drivers that we're going to get into. Here's a chart, in fact, page 2 here, essentially showing us a lot of the things that are on people's mind across, what the goings on in DC, the economy, and geopolitics. So it's things like the very unfortunate war in Ukraine with Russia's invasion there. It's things like sustained elevated inflation and the fact that, hey, for all the things that might be going on with the Fed or other things, it's impacting people, right? It's impacting people as they go to the pump, as they go to the store. But it is, as I mentioned, affecting Fed policy. The Fed's has had to turn much more hawkish, and rates are going up in anticipation of further Fed rate hikes. So that's got people a little bit worried. Unfortunately, we're still in a pandemic. So even though cases have been calm here in the US, there's some effects going on globally that we're going to get into. And we actually are seeing case counts rise a little bit here in the US. So the pandemic is still with us, and the effects of that, and at least globally in terms of shutdowns. This is all weighing on the consumer. For number one, and the consumer is really important when it comes to driving the economy, driving company earnings. Having an active and engaged consumer is very important, and that all then leads to the big question. One of the big questions being, are we headed for a recession? We all know the answer is eventually yes. The real question is when. And then also, as it relates to some of our investments, especially in the equity markets, what's up with earnings? What does this all mean when it comes to companies doing their business and ultimately producing value for shareholders? So those are the kinds of things that we're seeing in terms of drivers of volatility. This has also been a dramatic year with the doubling of, the sort of coordination, if you will, of negative equity returns combined with higher rates means negative bond returns. Page 3 here shows that the typical balanced portfolio of stocks and bonds usually has one of the two categories performing positively, much of the time both. But if one's down, the other tends to be up. And really, when we look at full calendar years, going back a long time, really 2022 so far is the first year where both are in negative territory. So obviously people are looking at their portfolios and scratching their heads in terms of, number one, where does it go from here? Number two, what do we do about it? So we'll get into that a little bit later. Now, as it relates to the economy, and this is where I want to sort of eventually here turn to the conversation. It's been an interesting time, right? When we look at 2021, this is sort of policy-fueled rebound from some of the challenges of 2020. Basically, GDP, real GDP, was the best print in 37 years. And so you can see, that specific number, very positive. And then, Lindsey, we put here on this chart on the far right, your forecast, at least up until the last few days, for 2022, at I think 2.5%. And we can see that's above trend in recent periods. And so of the last 13 years, I think 3 other times it's exceeded 2.5%. So what's not presented visually on this page, but got everybody's attention, was the first quarter. We actually had a negative print here in the US, and I think just Japan might have just issued a negative print as well for first quarter. Caught everybody by surprise. Obviously, technically speaking, if that happens again in second quarter, we have a recession. Before we get to that though, Lindsey, let's talk about that first quarter report. And I always like to think, okay, what were the negative surprises? Where did we see some strength? So let me turn it to you to start.
Perfect, thank you. Well, the headline drop in the first quarter, down nearly 1.5%, 1.4%. It was certainly larger than expected. However, the headline weakness was somewhat overstated. The majority of the decline was centered around 2 different things. One, a ballooning trade deficit, which actually shaved off more than 3% from headline growth, and inventories, or lack thereof, shaving off nearly a full percent from headline growth. So in fact, if we exclude inventories and trade and look at something called real final sales to domestic purchasers, growth at the end of the year, meaning the end of 2021, rose 1.7% and actually accelerated into the first quarter, up 2.6%. So in fact, when we smooth out this volatility, growth has been averaging right around 2% for the past 6 months, very much in line with the Fed's assessment that the domestic economy, while not overly strong, remains on solid footing. That being said, at 2%, this is still a questionable level of activity to withstand a significantly more aggressive Fed. But to your point, Michael, yes, there were some bright spots. Consumer spending remains very solid, up over 2.5% in the first quarter, and business investment rose nearly 10% at the start of the year. We saw double-digit gains in equipment, a 9% increase in intellectual property. So there were very clear indications that consumers are still spending, businesses are still investing. Going forward, with rates on the rise and prices continuing to pose a challenge, the question remains, though, will consumers and businesses be able to maintain this positive level of activity?
Yeah, exactly. We'll get into that a little bit more. I think of it as a thread through our discussion, in particular about the consumer, as mentioned. And so let's plan on that. Now, staying with you, Lindsey, I guess the other big topic, so GDP, where we headed, et cetera, is of course inflation. Inflation is high. It's been sustained at a high level. And there's this debate we've talked a lot about that whether we're peaking and seeing a turn and headed at least eventually back down. So I guess it's a 2-part question to you. The first is, what's your view on inflation peaking? And then when we look out, let's say a year or 2 years from now, what are you seeing?
Well, I think let's start with the 2 largest factors impacting inflation, because that ties into why I think inflation hasn't yet peaked. And right now we're facing renewed supply chain disruptions. And of course, as you mentioned, the latest conflict overseas. Now, with that in mind, yes, we did see some improvement in the latest figures. We did see headline growth slow somewhat in terms of price pressure, still positive price appreciation, but that second derivative improvement of a slower pace of accumulation. But this likely reflects improvements in the global supply chain at the start of the year, before Russia invaded Ukraine and before that second and third round of lockdowns that we've seen in China over the past few months. Now, more recently, we see Chinese manufacturing activity stalling back into contractionary territory, with some industry insiders suggesting that supply chain disruptions have actually worsened and are now as bad as they were during the lockdowns of 2020. So while the market is very anxious to call a peak in inflation, we do have to keep in mind that it takes time, months, for these disruptions to be felt down the pipeline in the US. So the impact of the latest policy response in the way of increased waiting times, higher prices, this has likely not yet been felt in the inflation figures. But we're really sort of splitting hairs when we're talking about have we peaked, have we not peaked? It's very likely that inflation remains elevated for quite some time.
Got it. Okay. And we'll come back to that in terms of talking about a forward-looking view. Hey, Brian, let's turn to you and focus in a little bit on China. So, for example, Treasury Secretary Janet Yellen, we understand, is signaling that tariffs are a contributor to inflation. So the tariffs with China. And so let's start with that, sort of the administration's policy on tariffs, any movement, and what you think in terms of what's going on with the U.S. and China.
So, Michael, there's a bit of a conflict within the administration of what to do with the tariffs. And let's take a step back. So people should know that the law that the Trump administration used to impose the tariffs has requirements that after 4 years, the tariffs expire. And that's where we are. They were imposed in 2018. We're coming up on the expiration date. So the U.S. Trade Representative, which is separate from the Treasury Department, has started the legal process of reviewing those. As you noted, the Secretary of the Treasury, Secretary Yellen, seems to be inclined to remove them, but the U.S. Trade Rep seems to want to keep them in place. She thinks that they're helpful in negotiations. They give the U.S. leverage in negotiations with China. So you have a split within the administration. I think Capitol Hill generally wants to keep them in place. It's been interesting, there's a bill on competition with China that has a whole host of things I won't go into now. But so backing up for a second, in the Trump tariffs, there was a list of exclusions to those tariffs. Now, those exclusions have expired. And so there's been a battle in this debate over the China bill of whether to reinstate the exclusions. And it's interesting, back in the winter when the Senate was working, last year, I'm sorry, when the Senate was working on its bill, it had an amendment that it voted on. There was overwhelming support that would have included the reinstatement of the exclusions, excuse me. Now, that, I don't want to get too deep in the weeds, probably already have, but that amendment had other factors. So it's not just a straight line reestablishment amendment. But recently, the Senate had a procedural vote just on the reinstatement of those exclusions, and the vote got very tight. I mean, it went from a 90-4 vote to a 53-47 vote. So you can see kind of this bipartisan momentum away from exclusions in favor of the tariff. So I do think there's political support for keeping the tariffs in place.
Can you tease that out, though, in terms of that shift in the balance of vote? What was the driver of that?
I think a large part of it, so I think there are two components. One was the first time a lot of lawmakers thought they had a free vote. It was a big, broad amendment. There were things that you could kind of grab onto that you may have liked, even if you didn't like parts of the rest of the amendment. So you could jam a lot of things in, and it's tough to read too much into that vote. Now, two things. One is this was strictly a vote about the exclusions, so there was no hiding behind other parts of it. And there's been pressure on the Republican side. In conservative media circles, there's been lots of talk that this is a vote to go soft on China. And I think that was in large part for why a number of Republicans voted yes the first time and switched their votes the second time.
Got it. And so I think, and we'll get into it in a moment, but I think we're probably sort of drifting into territory of behavior in advance of an election.
Yes.
And indeed. So, but before we get to that, I want to stay with you, Brian, and talk about the situation, an unfortunate situation in Ukraine, really from a couple perspectives. The first is, and again, the DC sort of population, the support there from Congress and the administration for sort of military involvement, or at least support to Ukraine, number one. So where do we see people landing as it relates to that? And then number two, the overarching issue is who's in NATO and who's not. And so we have now Sweden and Finland, I think, formally applying to join NATO. I'd be interested to hear your perspective on the U.S. Support of that or not, in terms of what's going on.
There are political links to the situations regarding China and Ukraine, and that really is mostly on the Republican side, because there is this growing voice within the Republican Party of isolationism. It's a traditional, old-fashioned Republican view that has been kind of suppressed for decades, but is reemerging. And so we saw that in the China issue that we just talked about. I think you're seeing it reemerge regarding Ukraine. So there has been strong bipartisan support for aid for the Ukrainians. There is pretty strong bipartisan opposition against troops on the ground, and that's why we haven't seen U.S. troops going abroad. But the latest vote in the House for additional aid to the Ukraine, like 50 no votes from Republicans. That's indicating that Republicans are growing uneasy with aid going abroad when there are problems here at home. And so that isolationist vein tendencies within the Republican Party is starting to reassert itself. So that's where we are on Ukraine. Now, I do think support for Ukraine will continue, but it's going to be less bipartisan than it has been. On NATO itself, it's you mentioned that Sweden and Finland have both petitioned to join NATO. Turkey is opposing, for now, that endeavor, and admission into NATO needs to be unanimous. So Turkey has a veto. Whether that they are just using this to advance their own strategic goals, where they're looking for something in return. There are issues regarding the Swedes and the Finns' support for different ethnic groups in that region of the world. Would Turkey get something in return for agreeing to NATO membership for those countries? Too soon to tell. So, but it's not a straight shot for either country to get into NATO. Look, it sure, if they were to get in, it certainly shores up the NATO alliance and makes it stronger, but it's not without risk. The problem with Vladimir Putin is now he's becoming increasingly isolated. The war's not going well. It certainly has not gone according to expectations within the Russian leadership, and an exit strategy is very unclear. And if they were to join, does that further corner him and make a withdrawal from Ukraine, a ceasefire, some kind of an agreement? Does that make it tougher? Does he lash out? I don't think anybody has those answers, but it certainly is a risk of Sweden and Finland joining NATO.
Yeah, and I guess the way I think about it, again, just a very challenging and difficult situation, and that uncertainty in terms of how Putin, for example, might conduct himself going forward is a big variable. Bringing it back here to the U.S., Lindsey, let's come back to you and talk about, given this environment, everything we're dealing with, elevated inflation, the Fed obviously took a big pivot towards the end of last year into this year, turned much more hawkish, signaling, more rate hikes, signaling, reducing the balance sheet, and essentially signaling still that they believe there's a good chance, maybe not a certain chance, that we'll have a soft, or at least a softish landing. So I guess from you, maybe an update in terms of your monitoring of the Fed. I know you're very close there. And also, when you look at data, what kind of data are you looking at to try to discern whether we're headed to or in a soft landing?
Well, at this point, I do think the Fed has taken a very clear stance that an additional 50 basis point increase in June is all but inevitable. So yes, we did anticipate a 50 basis point increase in May. We do expect a second one, a second 50 basis point increase in June. But with growth already slowing at the start of the year, we have rising risks of recession. I think it's going to be very difficult for the Fed to make the argument to continue rate hikes at this more aggressive 50 basis point pace beyond next month if, and this is a big if the intention is to avoid an outright recession. But as we heard from the chairman yesterday, that may be a necessity if inflation continues to push higher or remains at these elevated levels. But keep in mind that even if we do see the Fed reduce the pace of, reduce the size of increases back down to 25 basis points in the second half of the year, even at this relatively more benign pathway, that's still 125 basis points of tightening in the first half, followed by an additional 100 in the back half, or 4 times 25. This would still bring the upper bound of the target to 2.5 by year end, well above some of the Fed's earlier, more dovish forecasts. But to your point, Michael, yeah, the Fed is still very optimistic that they're going to be able to navigate a soft landing. Now, the Fed doesn't have a great track record for this by any means, but if we look at the Fed's latest forecast for GDP, they're still expecting 3% growth this year, even on top of their expectations for more rate increases relative to their earlier forecast of just 3, when they expected 4% GDP. But when I'm looking at the data and I'm trying to determine whether or not we are in fact headed for that ideal soft landing scenario, first and foremost, we're paying attention to the health of the consumer. Now, as we saw earlier this week, retail sales came in somewhat robust, suggesting that consumers are still spending more in some cases. But we know that inflation is complicating the picture because they're taking home less, as sales have not been enough to keep up with inflation. And going forward now, I am increasingly concerned that it's going to be more difficult for shoppers to maintain even this moderate level of expenditures as the impact of federal stimulus completely disappears, interest rates rise further, and savings, that wealth accumulation that we had built up during the pandemic, continues to dwindle. But from the Fed's perspective, ongoing positive spending activity, at least for now, I think reinforces the committee's notion that the economy is strong enough to withstand a further backup in rates, as again, the Fed's primary focus is to control inflation.
Yeah, you know, when it comes to the consumer and in some ways the goal of the Fed becoming more hawkish, in my mind, it's all about slowing things down. And maybe it's the demand side of the equation when it comes to the pressure on inflation. You know, there's certain measures that the industry has for financial conditions, you know, where interest rates are is one example, but another important element of that is asset levels, basically asset valuation levels. Now we're down roughly 17% year to date on the S&P 500. So by the industry metrics that we track, financial conditions have tightened. So, you know, I think one observation I would make is, you know, when we all would talk in the better times about the wealth effect of rising asset levels and equities going up and people feeling better and therefore being willing to go out and spend, it seems like we have to face the possibility that the reverse will be true. People will get their statements, feel a little bit more constrained in terms of spending. But anyway, one question I have for you on Fed policy, and over the last few years, they've used the term data dependent. It's not so much used today, but the concept is still there, which is, hey, we're going to watch things carefully and adjust policy as we go. So we've heard some experts in our industry talk about, well, they're really not going to go as far as they're signaling right now because the effect will kick in and they won't have to go all the way in terms of hiking rates as much as they've signaled they're planning to do. I guess a two-part question. One is, do you believe that's the case, that they will be data dependent, and maybe it is mostly a focus on inflation? And then number two, given what you think will unfold, do you see them following through with the kind of rate hikes they've been signaling?
Well, I do think the Fed is very much data dependent. And as we heard from the chairman yesterday, they're going to be focused on the inflation data, but they want a discernible indication that inflation is beginning to retreat. So essentially paraphrasing what the chairman said, he said, we're not going to be splitting hairs. We're not going to be changing our pathway based on a 1/10 percentage point decline, going from 8.3 to 8.1. That's not enough. The committee wants to see a very clear downward trend in prices before they're willing to back off from additional rate increases. Now, that being said, the Fed is somewhat optimistic that inflation will come down slowly in the second half of the year, but more markedly into 2023 as balance is restored to the global marketplace and we do begin to see supply chain dislocations removed, and also resolution hopefully is reached in the Ukrainian-Russian conflict. Now, should those scenarios come to fruition, I absolutely agree with the Fed's optimism that inflation will come down more abruptly next year, and that removes the pressure on the Fed to continue along this very aggressive rate pathway. So yes, the Fed has laid this out and they're committed to hiking rates as much as they need, but the Fed may not need to raise rates as much as they've projected if in fact we do see some of these organic factors remove some of that pressure on the inflation picture.
Excellent. So let me, as it relates to that outlook next year, let me pull our slides back up, and Lindsey, stay with you to speak to the following. So here again, from a recent report at least, is your forecast for the full year of 2022 at about 2.5%. So I guess number one, have you changed that recently? But then more importantly, I think when we look out to next year, what are you seeing, and where does that stand compared to both consensus and trend from your perspective?
So at this point, again, we do expect the Fed to continue to hike through the end of the year. And that is very likely to be enough to undermine growth. And we expect the first negative print to come in Q1 of 2023. First negative print independent of an inventory cycle, as we saw at the start of 2022. Now, we do not have an outright recession priced in at this point. However, if the Fed does continue along with a more aggressive pathway beyond what we've assumed in our base case, I will take that into account and we will likely revise growth lower. But at this point, we're looking for a very short-lived dip into negative territory. The Fed acknowledges that signal, backs off enough, and allows positive growth to resume the next quarter, leaving us right around that pre-pandemic level of about 1.8% GDP for the year.
Got it. Thank you. All right. So Brian, I want to come back to you and talk about the midterms. You know, and it's. I was going to say it happens. It seems to happen every once in a while. It's every 2 years that we're doing this. We kind of get together and really talk about the calculus of the environment. So when I look at things here, you know, really everything that's going on, the economy, consumer sentiment, et cetera, has to be playing in. But just at a high level, what do you see as top of mind to voters as we are approaching, not too many months from now, the midterms of 2022?
Michael, I think you hit the top points, which is inflation and the economy. Those are consistently ranking as the top concerns for voters. They also are worried about the border and crime, all not great issues for Democrats in the Biden administration, but it definitely at the top is inflation and the economy. And you know, the president's job numbers are weak. So I think this is all a reflection. It's going to be a referendum on him.
And so let's tease that out a little bit. We have this little technology with Zoom for Q&A. I had a question pop up from one of our viewers, really to kind of tease out, are we seeing any sort of policies or actions, let's start with the administration, that are specifically targeting trying to help with the inflation problem? And, you know, since we're talking about the elections, when it comes to both the administration and Congress, how do you see that fight against inflation kind of playing into activity here in the coming months?
So there have been a couple of actions. I don't think they're overly impactful. A lot of it is political messaging. So I don't to be a lot happening from Congress administration that dramatically changes the trajectory of inflation of the economy. So the administration released reserves from the Strategic Petroleum Reserve, has had a very modest impact because gas prices are back up to record highs. The president announced that he's going to extend into summer the biofuel mix, which allows more ethanol in gasoline over the summer. Again, this is not impacting gas prices. You know, the administration, you know, I think politicians in Washington have greater, more effective tools, and I'd also be interested to hear Lindsey's take on this. Actually, if you have a demand side problem, like there's a lack of demand, and I don't think fiscal authorities and the administration, Congress and administration are well suited or have the same tools as the Fed in terms of fighting inflation. So I think the administration's in a really tough spot in terms of fighting inflation, taking actions ahead of the midterms. I mean, you know, and there's always a lag time. So we're already into May. The elections is really creeping up. I think what's done is done. The economy and the inflation, at least as voters view it in terms of November.
Yeah. So Lindsey, just to turn to you, you know, and I kind of think of it as a general comment as it relates to Congress and the administration, actions they can take to help or sometimes hurt the economy, inflation, et cetera. Anything that you would add on that topic?
Well, to Brian's point, I don't think there's much that the fiscal side of the equation can do to assist in inflation, but they can do less to make it worse, or they can do less to stop making it worse. Let me say that. We do know that money supply growth is up 40%, and this obviously has created a substantial influx of dollars into the economy. Going back to Econ 101, as we all remember in school, too many dollars chasing too few goods. So there is a demand side component to the inflation pressure that we're feeling in the economy. That being said, about 80% of that pandemic stockpile of wealth has already filtered through the system. Now, 20% is still out there, still helping consumers to spend and have very large appetites for everything from game consoles to outdoor grills. But it is being addressed, and it's already mitigating itself, at least from the demand standpoint. The bigger component stems from the supply side. As a result, as we talked about, conflict overseas, supply chain disruptions. So again, that falls on the fiscal, or excuse me, on the monetary policy side. But as the Fed raises the cost of capital, that only addresses tapping down investment, tapping down consumption, but it does little, if anything, to address price pressures as a result of these supply chain issues. So one of the things that I am concerned about is that the Fed continues to raise rates, trying to get inflation under control, but all we do is undermine the economy, resulting in more of a stagflation scenario, which is just a fancy word to say prices are still elevated, but now we also have to contend with the effects of a weaker economy.
Yeah, and that, you know, stagflation is something we've been publishing about, and I think of it as we're all monitoring for it. It's sort of a double whammy. Brian, coming back to you in the midterms and the calculus, there are a couple of things unfolding that I know our clients care about on many levels, and included in that would be their influence on the election. One is the January 6th situation where I assume we're going to start to see increased activity from that situation. And then number two is the leaked opinion on Roe v. Wade. And you know, my targeted question, not to get into what's right, what's wrong, is given those two sets of activities, I guess, what is your general outlook for a seat swing or not in each of the chambers of Congress? And then how are those specific events expected to affect those?
So the January 6th, the House Committee on the January 6th incident is probably going to hold public hearings over the summer. And obviously between now and the next couple of weeks, we're going to get a decision from the Supreme Court's case, which deals with Roe v. Wade and whether that should be in place, repealed, trimmed back. We obviously have the leak of the decision, but anyway, I'm skeptical that either one of those events is going to have a material impact in the outcome of the election. Let me take them separately. The January 6th issue, I think people have just made up their minds on what was right, what was wrong, who's to blame, who's not to blame. I think it's going to, and there's been so much coverage of their investigation and so many leaks and so many books already written. I don't know that they're going to come up with anything new, novel, changes people's minds. So I think that's baked in. The issue of Roe, obviously a very delicate issue. So I speak about this dispassionately in what vulgar political terms. I am skeptical that has a big impact on the elections, and for three reasons. One, just the who cares about the Roe decision and the court case. It plays biggest with white college educated women, and that group is already so heavily skewed to the Democratic side. It's tough to see where Democrats get more out of that demographic group. Second, Hispanic voters moving to the GOP, and that group tends to be more pro-life. And third, going back to what voter priorities. So they may say they want to keep Roe in place, but they don't prioritize it. When you look at how voters prioritize issues, the economy and inflation and crime are at the top of the list. And there have been some interesting focus groups that have come out recently. One, I think Reuters covered in Arizona, and with a group of mostly pro-choice women, they are saying that this is not their big issue, that it is the economy and it is inflation and it is crime. So I'm very skeptical that these non-economic issues, these social issues, are going to impact the election. And so it gets me to where we are. As you have the slide up of what the current makeup is, Republicans only have to pick up a handful of seats. The average turnover in a midterm election is 26. Now, Republicans picked up 13 in 2020, so they may be capped a little bit, and the court decision could cap their gains. I just don't think it dramatically changes the political calculus. But you know, I've been thinking 20 to 30 seat pickup for Republicans. It could go more than that. Maybe the court case caps it at 40. Just a rough guess. The Senate, you had an earlier slide up. There it is right now. 21 Republicans up for re-election, 14 Democrats up for re-election. That means that Republicans only have a handful of pickup opportunities. And the map's not terrible for Democrats. And I've noted in 2018, a great year for Democrats. I mean, they picked up the House, they gained 40 plus seats in the House, they lost 2 seats in the Senate. Could we see that just flipped? Possibly. I think likely. I think the national mood is so in the Republican direction that at this point, the most Democrats could hope to pick up in the Senate is one, but a split, a continued 50-50 Senate is not out of the question. But so I'm kind of in some range of Democrats picking up a seat, Republicans picking up 2 seats. That's kind of where we are.
Got it. Okay, that's helpful. And if kind of on either side, if that plays out, we're in what is really traditionally a divided government. I guess, Lindsey, back to you. An unscripted question for sure, but when you think of the effect of what's going on in DC, the makeup of Congress, whether it's a unified or a divided government, any comments on, again, the effects of the election, the effect of the outcome on the situation with the economy from your perspective?
I think one of the biggest question marks that has been left, maybe not unaddressed, but we haven't fully gotten to the bottom of it, and that's the BBB bill. If Democrats do gain more seats, more power, it's very likely that BBB reemerges. Maybe not in the entire capacity of the 1.75 trillion, but in some capacity, I would expect that to be reintroduced, and maybe be reintroduced with a bit more vigor and support coming off the November elections. Again, if Democrats gain more control. That being said, an additional, let's call it 2 trillion of some sort going out into the economy, it seems to be the exact opposite type of scenario that we'd like to see from an inflationary standpoint. Further increasing the supply of money at a time when the Fed is rapidly raising rates, trying to control inflation, seems to be very counterproductive. It's the opposite of what we'd like to see from an economy standpoint, from an inflationary standpoint. We'll put politics aside, depending on your support for individual components of the bill. But that is one concern that we are keeping our eye on. So certainly the November elections, aside from all the other issues that Brian touched on, does have significant potential impacts for the economy if we see more government spending being proposed.
Thank you. Very helpful. What I'd like to do now is I want to turn it back, and I'll come back to each of you before we close out, but let's turn back. We've gotten a couple questions fly in the system here really about market implications. So I want to turn and sort of focus on that for a couple of minutes, and then we'll sort of go to closing comments. So I guess let's start with, we're getting the question all the time, should I sell all my stocks? So stocks are down 17%. And, the bottom line is for the long-term investor, we think not. You'll hear the term all the time, stay the course. And this chart on page 7 really captures why that's important. What we do here, just to show you the arithmetic, is we go back to over the last 20 years, and we basically start at $100. And the blue line is essentially the S&P 500. And it's, chops around a little bit, but there's this sort of longer term growth. And you can see it's roughly a 6-fold increase over the 20 years, a little bit of a move down recently. And then what we start doing is we say, look, these trading days that were really positive, let's basically clip off of that history, however many days we need to eliminate that entire return. And what I would have thought as a sort of a math guy is if I started that, hey, maybe it's 100 or 200 days. Yeah, it's basically 30 trading days. So think of it this way. You're in for 20 years. You pull out for the wrong 30 days and your return goes to 0. And, what I would say is, even though, yeah, you could probably look at certain days and say, like today, probably, boy, I wish I was out on that day. But the reality is of trying to time the market well and be out for the bad days and back in for the good days, that's very hard to do. In fact, they often come together. We had a pretty positive day yesterday, I think a very negative day today. And so to kind of flip in and out is really hard to do. So we'll often talk about the power of time in the market rather than timing the market. So number one, stay invested. Honestly, if it's a time where you're looking to put more money to work, and we'll look at, I think, at a couple charts that relate to this, but at least let me talk about it conceptually. In these periods when people feel really blue, so when we look at things like polls on bears versus bulls, the bears are greatly outnumbering the bulls right now. Same thing with consumer sentiment. People are kind of, as it relates to their view on the environment, maybe the view on the markets, a little bit cautious and worried. And yet, typically by history's pattern, that's often a time to basically put money to work. So if somebody's looking to invest, our answer is this isn't a time to wait, but also not a time to jump all in. And the bottom line is what we see is just this idea of being methodical. Sometimes you'll hear it described as dollar cost averaging. It's a time to sort of just stick to your plan, basically, in terms of remaining invested. And if it's time to put a little more money to work, put a little bit more money into the market in a methodical way. Now, I mentioned at the beginning the idea that the 60-40 portfolio, the diversified portfolio, is challenged this year. And so I'd make two statements. Number one, we think that won't be sustained, meaning that typical historical pattern of the two asset classes being good diversifiers for one another, we think will hold up longer term, and that we're in a little bit of an aberration. But even so, it's never a bad idea to look for ways to diversify. So number one, let's say you're an equity investor, but you're focused mostly on large cap stocks. Not a bad time to be considering diversifying a small amount of your portfolio into smaller cap stocks. A second dimension might be adding another asset class. So, for example, and it seems unintuitive because some of these areas have run up, but still, it could be a methodical build towards a greater allocation. It could be things like real estate, commodities, or even alternative investments. So things to think about and really talk through with your financial advisor. That's the kind of thing we're thinking. As it relates to putting money in the market, another question we get a lot is, where's the market going? And I will confess, we are not ones to time, over the next month, it's going to go from here to there. I tend to have about a 1-year view and out. And so I always ask myself the question, given where we are today, if I had to take a guess, really, given all the fundamentals of what's going on, given that oftentimes these worries and some of this anticipation of additional problems, even a recession, are what are typically priced into the market, I have the view, and our team has the view, that a year from now, equities will likely be higher. So will we see more volatility here in 2022? Yes, we think so. But net, when we add it all up and look out a year from now, we believe markets will be higher from here. In any event, here on page 8 is a chart that reminds us of the power of equity investing. This is going back really to the Depression and basically the rotation between bull and bear markets, sort of the role and timing of recessions as we go. And I think the takeaway here is twofold. Number one, it is inevitable that we will have a recession. It's going to happen. Number two, we will probably coinciding with that in some form have a bear market. But for a long-term investor who remains invested, the economy tends to recover, the markets tend to recover, and when it's all said and done, the positives outweigh the negatives. So again, we're advocates for diversified investing. We're advocates, though, for those that are long-term investors to stay and remain invested with equities. So I wanted to kind of close out and ask just a couple more questions. I'm going to come out of the share. And maybe, Brian, let me start with you. And we talked before we kind of launched the webinar today. So we've had a challenging period, right? It's sort of a quasi-divided government with the Democratic Party a little bit fractured and unable to get all of their sort of programs and platforms enacted. And we may head towards a divided government. But when you look at sort of what's going on in DC, and again, loaded question, I'm interested in where you see glimmers of hope out of our government and things that come from that in DC.
You know, politically, they usually come from, you know, from and at times when you least expect it. So, you know, it's tough to answer that question with any kind of accurate foresight. Look, I do believe that, you know, given, you know, kind of taking a contrarian view that, you know, the country's badly divided. The right track, wrong track numbers are way upside down. I guess maybe it's, you know, it can't get worse. And so at some point, the country tires of the chaos and the bickering, and, you know, and voters, it's up to them. They decide to pursue less drama, less chaos. Actually, there was a House race, a primary last night in North Carolina, and I won't get deep into the details, but the incumbent Republican who lost was an overly dramatic member who just was able to get himself into all sorts of problems, and voters just said enough. They had it, that he wasn't representing them the way they wanted to be represented, and they chose a more traditional type of candidate to represent the Republican Party in the election. Maybe that is a good sign of what's to come in Washington. Less drama, less chaos.
I mean, I will tell you, just I'm sure, like you, out and about in our world, right? Whether it's business or personal lives, oftentimes I'm talking to people about things, and everybody's kind of moderate, right? We're all sort of, many of us clustered in the middle, but the noise seems to come from the edges. Now, Lindsey, turning to you and our economy and our system, you know, I think all of my colleagues know me to be almost obnoxiously optimistic. I'm always looking for the positive. And I guess to you, what I'm interested in understanding is your perspective on, you know, it's almost like we're worried about, you know, the Fed's policy. We're worried about, you know, what might cause a recession. To me, the power of the economy, we're talking about, you know, whether we're going to grow a little bit or fall a little bit, but the engine itself is pretty darn strong. So I guess from that perspective, you know, maybe end on a couple of notes that you see as positives in terms of our system, the economy, strengths where you see it.
Well, just talking about the engine in general, I mean, to your point, we have one of the largest, most entrepreneurial labor forces in the world. And so if there is an economy driven by consumers and investment, I mean, the US has the best chance of having a relatively stronger rebound. Now that being said, I also think that there are some glimmers of hope when we look at Fed policy. Now, you may not have the famed Fed dot plot laminated on your refrigerator, but what it shows us is that there is a wide array of opinions among Fed members, many forecasting well below the consensus in terms of the number of rate hikes that we're going to see going forward. So the market often focuses on the loudest voice, specifically St. Louis Federal Reserve President Bullard, but there are a lot more cool heads prevailing at the Fed that may early on see some of these signs of weakening and encourage the Fed to back off sooner rather than later in an effort to try and navigate that soft landing. So I do think that the Fed is going to, despite its tough rhetoric against inflation, and yes, I do believe that they're going to get prices under control, at the same time, they don't want to pull the rug out from under the recovery. So I do think their bark is going to be a little bigger than their bite.
Oh, that's a good way to put it. I want to end with a couple almost shameless plugs. First, I'd say, you know, we're all sort of living with this technology. We had, I don't know, 4 or 5 people raise their hand here in Zoom. I don't really know what to do with that, but to them, I would say if you have topics or questions through your financial advisor, we're fully prepared and ready to speak to anything you would like us to, just on a more of an individual basis. So talk to your advisor, have them shoot an email to us, and we'll be responsive. Number two, we got a couple questions that really wanted to go deeper on the markets. It turns out right after this event, I'm going to record our monthly video called Investment Strategy Brief. So it's 20 to 25 minutes diving deep into market valuation levels, and interest rate direction, dynamic leanings, what we think of different kinds of investments. So I'd invite you to talk to your advisor. It'll probably be released on Friday, and it'll give our freshest views on the markets in a recorded format. Anyway, my final comment is for these two colleagues. One of the things we've been working on, both Lindsey and Brian do just a tremendous amount of work, and we're going to essentially enhance the way that we deliver that to our wealth management clients. So in the coming week or so, we'll see a great weekly video from Lindsey, a weekly note from Lindsey, and then about every week or two, Brian, your publication. But again, sort of sent through our normal distribution approach to our work. And so I would invite everybody viewing to check out all of their work. It's just fantastic. So with that, we're going to close it out. Lindsey, let me start with you to say thank you so very much for joining us today.
Thank you for having me. This was fantastic. Thank you, Michael.
Great.
Thank you, Brian.
Yeah, Brian, thank you.
Thank you, Michael. It's great to be on with both of you, and looking forward to doing more of these.
You got it. Hey, it's an election year. We'll be back soon. Take care of everyone. Thank you.
Have a great day.
Thank you.